Why assets don't equal cash? Let's see why. Many people assume that if a business owns a lot of assets, it must be financially strong. On paper, the numbers look impressive and confidence follows, but in real life, that confidence often collapses when bills are due and cash is missing. This video explains why that gap exists. If you have ever wondered how a business can look healthy but still struggles to pay expenses, this concept is the missing piece. Stay with me because once you see it, you won't read balance sheets the same way again. Assets help explain value, but cash controls survival. Businesses don't fail because they lack assets. They fail because they run out of usable money at the wrong time. This difference shows up during payroll, rent, inventory purchases, and emergencies. Understanding this helps you avoid false confidence. Whether you are a freelancer managing receivables or a startup planning growth, this knowledge protects you from decisions that look strong but feel painful later. An asset is anything a business owns that might help it later. It could be products sitting in storage, tools used to work, or money customers still haven't paid yet. On paper, all these look valuable, so accounting records them to show the business's position. But here's the key idea: future value is not the same as usable value. Just because you own something doesn't mean you can use it right now. That gap between owning something and being able to use it is where most people get confused about money in business. Cash is the money a business can use right now. It doesn't need to be sold, collected, or processed first. When an expense shows up, cash is what handles it. That's why cash feels powerful. It doesn't represent potential, it enables action. While assets might become useful later, cash works immediately. This difference is small on paper but huge in real life. Liquidity is about speed. It explains how quickly something can turn into usable money without losing value. Some assets convert quickly, some take time, and some only convert if you accept delays or trade offs. Time matters because expenses don't pass. Rent, salaries, and operating costs keep moving forward. So, even when asset numbers look strong, slow conversion creates pressure, and that's where problems quietly begin. So, what happens when liquidity is ignored? Inventory often looks like money sitting on shelves, but until customers buy it, that value is locked. Meanwhile, storage, risk of damage, or changing demand quietly reduce its usefulness. This is why businesses can appear asset rich yet struggle operationally. The conversion process matters more than the label. Receivables are invoices that have been sent but not paid yet. On financial reports, they increase the total value of assets, but in daily operations, they don't help with today's expenses. If payments are delayed or timing doesn't match outgoing costs, cash can feel tight even when work is already done. This situation is common in freelance and service work, where effort comes first and payment follows later. Financial reports can look stable while day to day operations feel tense. This because reports show totals, not urgency. Assets add up neatly on paper, even when they can't be used right away. This creates the illusion of wealth. The lesson isn't to ignore numbers but to interpret them correctly. Understanding what is usable now versus what may help later leads to clearer decisions and fewer surprises. Failure often happens quietly, not because value disappeared, but because timing didn't cooperate. This is why cash flow awareness matters more than asset size. Survival depends on alignment, not accumulation. For freelancers, this difference is easy to feel. Yet you finish the work, send the invoice, and the value exists, but the cash arrives later. Until then, flexibility is limited, even though the effort is already complete. Understanding this gap helps reduce stress. When timing is expected and planned for, decisions feel calmer and more controlled. It's not about earning more, but about aligning work payments and expenses more realistically. As businesses grow, assets often increase quickly. More inventory, more tools, and more unpaid invoices show up on reports. On paper, the business looks bigger and stronger, but growth also brings higher and faster expenses. Cash can feel tighter even while assets rise. Recognizing this early helps leaders stay balanced. Understanding that growth and liquidity don't always move at the same speed. Think of assets as stored energy. They have value, but you can't always use them right away. Cash is usable energy, ready to take action immediately. Both are important, but they play different roles in running a business. The key bridge between them is conversion. How fast an asset can become cash. Time is the cost. The longer it takes, the more careful you need to be. Using this mental model makes financial thinking intuitive without diving into complex accounting rules. You don't need complicated tools to understand cash and assess. Simple questions improve decisions instantly. This approach builds financial awareness without promising outcomes or shortcuts. Planning before pressure hits reduces surprises and builds better financial awareness. This isn't about shortcuts, it's about understanding how money flows and timing works in real life. Next, let's cover the common mistakes people make when they confuse assets and cash. Mistakes happen when numbers are trusted blindly. Awareness reduces risk even in uncertain environments. Learning these principles builds smarter decision making. It's not about chasing shortcuts or tactics, it's about understanding how resources actually work in real world business situations. Assets and cash serve different purposes. Assets represent potential value, while cash allows immediate action. Understanding the difference gives you the clarity in decisions and reduces surprises when timing matters. This principle isn't about shortcuts, it's about seeing the real picture. If this helped you think more clearly about business finances, engage with the channel for more practical, easy to understand explainers. Thank you very much.